The Dow Jones Industrial Average fell 953 points last night. The S&P 500 dropped 1.62%. And it all started before the market even opened, with a CPI number that told investors exactly what they didn't want to hear. Here's where Wall Street closed on Wednesday, the 10th of June. The S&P 500 finished at 7,266, down 1.62% on the day. The Nasdaq dropped 1.98%, closing at 25,169. The Dow fell 953 points, breaking below 50,000 for the first time in weeks, closing at 49,918. The 10-year Treasury yield held at 4.52%, easing slightly from an intraday high of 4.55. WTI crude pushed up 2.5% to around $90 a barrel. Gold, and this is the part that surprises most people, actually fell, down to around $4,200 an ounce, the lowest it's been since late March. VIX is elevated. Risk is off. And Australian investors woke up this morning to a very different set of opportunities than they had yesterday. Let's start with the data. At 8:30 New York time, the Bureau of Labor Statistics dropped the May Consumer Price Index. Headline CPI came in at 4.2% year-on-year. That is the highest reading in 3 years. And yes, that number is going to dominate the conversation all week. But here's the nuance that the headlines are glossing over. Core CPI, which strips out food and energy, rose only 0.2% month-on-month. That undershot forecasts. What that tells you is this: the inflation we are seeing right now is almost entirely an energy story. The Iran conflict has shut down the bulk of traffic through the Strait of Hormuz, which carries roughly 20 to 25% of global oil and LNG supply. That's feeding directly into pump prices, electricity costs, and transport, and those things are feeding into the headline number. But it hasn't meaningfully spilled into broader price pressures. Wages haven't re-accelerated. Service inflation is contained. That's the relief. The problem? The market doesn't care about nuance right now. 4.2% is a 3-year high. The Federal Reserve, now under Chairman Kevin Warsh, has a December rate hike fully priced in by traders. And higher rates are not good for growth stocks. Now for the reason stocks closed at session lows, not session midpoints. President Trump announced late in the trading session that the United States had launched new strikes against Iran. The trigger: Iran's military shot down a US Apache helicopter patrolling the Strait of Hormuz. Trump said Tehran would, quote, have to pay the price. Iran's Revolutionary Guard retaliated quickly, striking US military positions in Jordan, Bahrain, and Kuwait. The already fragile ceasefire that markets had been cautiously pricing in is now in serious doubt. And here's why that matters for your portfolio. The Strait of Hormuz is not just a geopolitical flashpoint. It's the artery through which 1/5 of global energy supply flows. Every escalation extends the timeline on the supply disruption. Every extension means more weeks of $90+ oil. More weeks of elevated energy costs feeding into inflation. More pressure on the Federal Reserve. This is the feedback loop markets are afraid of. Let's look at how sectors moved. Industrials were the worst performers, down over 3%. That's a broad risk-off signal. Industrials move on growth expectations, and right now the market is pricing slower growth. Technology fell over 2%. The semiconductor rebound from Monday, when the SMH gained 6%, ran out of steam. Nvidia, Broadcom, Micron, all pulled back. The AI trade is under scrutiny. Valuations have run far, and rising discount rates compress those forward earnings. The only sector that outperformed? Energy. And not by a little. Consumer staples held up reasonably well. Coca-Cola and TJX companies hit fresh all-time highs during the session. Investors rotating into defensives and dividend pairs when the macro gets this uncertain. Financials were lower. Materials lower. Real estate under pressure from the 4.52% 10-year yield. Now for the reason you tuned in. What does all of this actually mean for the ASX this morning? First, the open. The ASX is set to open lower. Based on the Dow's 953-point fall and where SPI futures are sitting, expect a gap down of somewhere between 0.8 and 1.2% from the gate. That said, the open is not the whole story today. There are divergent forces at work. Sector 1 to watch: energy. Woodside Energy, Santos, and Beach Energy are sitting in the sweet spot. WTI at $90 is the highest we've seen since the first weeks of the Iran conflict. The Strait of Hormuz is still near shut, and Trump just ordered more strikes. That is not a supply problem that resolves quickly. Woodside in particular has lagged the oil price move. There's a catch-up trade here, and early buyers may be rewarded. Now, a counterintuitive call: be careful with gold names today. Gold fell to around $4,200 an ounce. Why? Because gold is a non-yielding asset, and when the market fully prices in a December rate hike, gold gets sold. Northern Star and Evolution Mining may underperform the broader market today, which is not what most investors expect in a risk-off session. For technology names, the pressure from the Nasdaq's fall will filter through to WiseTech, Xero, and others in the local tech space. Nothing catastrophic, but the sector headwind is real. Banks are a watch. Higher US yields tend to support bank margins in theory, but the macro uncertainty around credit demand and loan quality in an energy shock environment creates noise. Watch the Big Four for early direction. The A.U.D to S.D cross is sitting under pressure from dollar strength. A weaker Australian dollar benefits our commodity exporters, BHP, Rio Tinto, Fortescue, but adds to imported inflation costs. The RBA is watching this dynamic closely. 3 things to monitor during the ASX session today. First, Woodside's open price and early volume. If the energy trade is as strong as the oil price suggests, you'll see it immediately in the open print. Volume confirmation matters. Second, Oracle reports earnings after the US close tonight. Oracle slipped 2.4% during yesterday's session ahead of the print. This is now a direct read on enterprise AI spending, the same theme that's been rattling chip stocks. A weak number tonight will flow into Friday's ASX Open. Third, Trump's language on Iran. Any signal of de-escalation would be a risk-on catalyst across the board. Any signal of widening conflict would push oil higher and stocks lower again. With negotiations described as taking too long, the next statement from Washington matters more than any economic data point this week. If this briefing saved you 30 minutes of noise this morning, hit subscribe and the bell notification. You'll get this every weekday before the ASX opens at 10. Drop a comment below. What are you watching on the ASX today? I read every single one. See you tomorrow.